I think this is a lot of smoke and not a lot of fire. I mean, the reality is the dollar is going to strengthen for the next 3 to 6 months as the Fed continues to raise rates. And there's a lot of inflationary pressure building up in the U.S. economy. So as this inflationary pressure builds up, the Fed risks being behind the curve. If they don't get ahead of the curve by raising rates, you're going to have a problem, I think, in terms of Fed credibility, and that's going to continue to put pressure on the EM complex. So I think broadly the volatility we've seen in the emerging markets is likely to persist.
I'm glad you brought that up, because we keep looking at emerging markets and thinking, ooh, sure, trade tensions aren't helping the space. But overall, do you think this is really about concerns around global liquidity? And perhaps the ECB isn't changing today, but there's an acknowledgement, too, that it's not just the Fed. We are looking at central banks around the world working towards normalization.
That's absolutely the case. And this is the first time in a very, very long time that we've actually seen a tightening cycle. Somebody told me the other day that about 30% of market participants had never seen a rate increase. Well, all these people have never actually experienced what you're likely to experience for the next 6 to 12 months. And so I would expect this tightening cycle to have a profound impact, especially on volatility of markets, et cetera. I think if you're a long-term investor, you just see through it, but long-term means years, not quarters.
That being said, if markets are currently too complacent about rate normalization, where should you be invested?
Well, so the way that this is a tough circumstance, because for the last decade or so, bonds have acted as a counterpoint to equities. Unfortunately, now bonds are what's causing equities actually to get more wobbly. So that normal safe haven status that you would expect from fixed income isn't behaving like that. Ultimately, that will be a case if you get a correction in equities. We would expect that government rates around the world should maintain current yield levels or rally. But until that happens, it's tough. We're advising clients, to sort of hunker down for the volatility. You can hide out in some places like cash or real assets, which have less cyclicality to them.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.